What if I told you there is a defense technology company sitting in your brokerage right now, one that just locked in over $150 million in brand new orders, signed a landmark partnership with Lockheed Martin, and is projecting nearly $400 million in revenue for 2026, and yet the stock is absolutely collapsing? What if I also told you that buried deep inside its options chain is one single anomalous data point, a number so extreme, so mathematically absurd that it could trigger one of the most violent upward price moves we have seen all year? And what if the window to position yourself before that happens is measured not in weeks, but possibly in days? Welcome back to Smart Stock Sam, the channel where we dig past the headlines, cut through the noise, and deliver the quantitative edge that the average retail investor simply never sees. I am your host, and today we are doing a complete, no-fluff, deep dive on Ondas Holdings, ticker symbol ONDS. We are covering the insider selling data that shattered confidence, a short interest figure that will genuinely make your jaw drop, a hidden option structure acting as a literal institutional price floor, Wall Street analyst targets sitting over 140% above the current share price, and a precise, risk-defined trade setup mapped out to the exact dollar. This is the complete picture, the kind of rigorous analysis you need before you make any decision on this stock. Stay locked in, because every section of this video builds toward the most important data point at the end. But before we talk about the opportunity, we have to understand the pain. Because without understanding exactly what broke this stock, we cannot understand why it might be coiling for a violent reversal. As of June 25, 2026, Ondas Holdings is sitting at just $7.68 per share. To put that in full perspective, this stock was trading at a 52-week high of $15.28 not long ago. We are looking at a stock that has been cut essentially in half from peak to trough, and the damage has not been slow. In just the last 30 days alone, ONDS has shed nearly 34% of its value. Year to date, in a market environment where defense and technology have had genuine tailwinds and real capital inflows, this stock is still down 19%. The chart looks like it fell out of a window. Retail investors who bought anywhere above $10 are sitting on deep, painful losses. Sentiment has cratered completely. When you look at a price action like this, every natural instinct in your body says one thing: run. Get as far away as possible. But instincts are not an investment strategy. So let us actually ask the question nobody seems to be stopping to answer. If this company is operationally thriving, what is causing the stock to bleed out like this? Three culprits are working together to crush the price, and the first one is the elephant in the room: insider selling. Around June 1st, Chief Executive Officer and Chairman Eric A. Brock sold roughly 2.37 million shares and walked away with nearly $32 million in proceeds. Over the trailing 6 months, insiders across the company have executed 23 sales. The number of insider purchases during that exact same period? 0. Not one single buy. Nothing shakes institutional and retail confidence quite like watching the CEO cash out at scale while the stock is already under pressure. It becomes a narrative that feeds on itself, and narratives in the short term can matter more than fundamentals. The second culprit is a supply overhang. The company recently filed a prospectus to register over 3 million additional shares for resale, shares tied directly to their Omnisys acquisition. Here is the problem with that. Every time the stock starts to find its footing and attempts a rally, investors immediately price in the fear that a tidal wave of new supply is about to flood the open market. That fear creates a ceiling. Every attempted recovery gets suffocated before it can build momentum and breathe. The third culprit is a textbook momentum collapse. On May 28th, ONDS spiked 20% in a single session, pushing up to nearly $13 on pure speculative enthusiasm with no real fundamental catalyst attached to it. What follows a move like that is entirely predictable. Momentum traders ring the register. Short sellers smell blood in the water, and the price rapidly collapses back to earth, then keeps going lower. That kind of failed breakout leaves a psychological scar on sentiment that takes weeks to heal. Three forces, all three pointing the same direction. Together, they have created a technically destroyed stock chart that has left retail investors exhausted and frustrated. But here is the critical question. Does any of that actually reflect what the underlying business is doing? No, it does not. Not even close. Let us flip the script entirely and look at the operational reality. In the second quarter alone, Ondas pushed past $150 million in new order intake. In June specifically, they locked down over $40 million in autonomous defense orders in a single month. This is not a company scraping the bottom of the barrel for revenue. This is a company experiencing genuine, expanding demand for its technology in one of the most well-funded sectors in the economy. Beyond organic order growth, they agreed to acquire Cyberhawk, a drone inspection firm, for $125 million, primarily in cash. Cyberhawk brings in the kind of recurring software and services revenue that the market assigns premium multiples to. This came right on the heels of their $196 million all-stock acquisition of Omnisys, which meaningfully expanded their counter-UAS capabilities and market reach. And then there is the partnership that truly underscores the legitimacy of their technology. Their subsidiary Centrix confirmed an integration of their cyber-over-RF counter-drone technology into Lockheed Martin's Sanctum counter-UAS platform. Let me be very clear about what that means. Lockheed Martin is one of the most rigorous, most demanding Tier 1 defense contractors on the planet. They do not integrate your technology into a live defense platform if it does not genuinely perform. That partnership is not marketing, it is operational validation. So how do we reconcile these two completely opposite realities? A fundamentally thriving business and a stock in freefall. We put them side by side on a scale, and we look at the divergence honestly. On the bearish side of the ledger, heavy insider selling, a dilution-driven supply overhang, a confirmed structural downtrend, and deeply damaged retail sentiment. On the bullish side, record order intake, a revenue pipeline projected to approach $390 million, Tier 1 defense validation from Lockheed Martin, and an expanding acquisition strategy building durable competitive advantages. The business is thriving. The stock does not know it yet. And history is consistent on one point. When the divergence between operational reality and market price gets this extreme, something eventually snaps back. The question is, which direction and what triggers it? To understand that, we need to look at the institutional ownership picture. Institutional backing remains significant at roughly 38%, spread across 378 different institutional holders controlling approximately 215 million shares. That is a substantial base of professional money that has not exited. But under the surface, the landscape is shifting aggressively. Citadel Advisors reduced their position by over 8 million shares. Jane Street cut their exposure by 7.45 million shares. When funds of that caliber make moves of that size, they move the price, and they explain a meaningful portion of that 34% monthly drop. But here is the crucial other side. While some funds were reducing, Defiance ETFs added over 10.3 million shares to their position. Smart money is not uniformly running for the exit. It is swapping hands. Some funds are managing short-term risk and booking tax losses. Others are accumulating at a heavy discount to where they believe this stock belongs. What does Wall Street actually think it is worth? The analyst consensus is staggeringly bullish. With the stock at $7.68, the median analyst price target is $18.50, is over 140% potential upside from current levels. Quantitative fair value models place intrinsic value near $19.50, suggesting the stock is roughly 54% undervalued right now. Needham reiterated their buy rating with a $23 target. H.C. Wainwright carries a $25 target. The street firmly believes this company is being mispriced by the market, and the gap between that conviction and the current price is one of the widest I have seen on any defense name all year. Now, none of the long-term thesis matters if you do not understand the immediate technical reality, and right now, short-term technicals are flashing a strong sell. The stock is in a confirmed structural downtrend, trading well below its 50-day moving average of $8.71, and light years below its 200-day moving average of $10.16. Trend-following systems and momentum traders want nothing to do with this name in its current state. But for mean reversion traders, this is exactly where it starts to get interesting. The 14-day Relative Strength Index is currently sitting at 32.38. Anything below 30 is considered extreme oversold territory, and we are right on that doorstep. The selling has been so relentless and so sustained that there are very few remaining weak hands left to shake out. The investors still holding at these levels are either strong conviction longs or deeply trapped holders. Neither group is likely to capitulate and accelerate the sell-off meaningfully further from here. The downside momentum is mathematically running out of fuel. And that brings us to the most important piece of data in this entire video, the hidden metric I promised you at the very top. Are you ready for this? The short interest on Ondas Holdings currently sits at 290% of the tradable float. 290%. There are over 161 million shares sold short. The actual float, the shares available to trade on the open market is a fraction of that total. What this means is that short sellers have borrowed shares, sold them short, and those same shares have been reborrowed and sold again in a massive daisy chain of rehypothecation, creating a synthetic short position almost 3 times the size of the actual tradable float. That is not a normal condition. That is a structural anomaly. And making it even more extreme, off-exchange short volume, the dark pool activity accounts for over 59% of daily trading. The bears have not just established control here, they have built an enormous, increasingly fragile tower of short exposure stacked on top of this stock. Here's why that matters so fundamentally. Every one of those short positions is a future buy order, waiting to be triggered. Short sellers must eventually purchase shares to close their positions. When a catalyst hits, whether it is a blowout earnings report, a major new contract announcement, or simply a decisive technical break above a key level, the scramble to cover does not happen in an orderly, polite fashion. It happens simultaneously, and it happens fast. That is a short squeeze. At 290% of the float, the potential energy stored in those short positions is extraordinary. This is the coiled spring. The setup is loaded. The only missing variable is the catalyst that releases it. To understand where that release might occur, we go to the options market, because the derivatives chain is showing us exactly where the battle lines are drawn. Implied volatility on ONDS is sitting above 101%. That tells you the market is pricing in violent, explosive price swings in either direction. But look at the actual structure of the chain. On the downside, there is a massive put wall at the $7.50 strike with over 12,200 open interest contracts. This is critical. Market makers who sold those puts are obligated to hedge their books by purchasing shares near that level. That turns the 750 strike into a concrete institutional support floor, not just a technical line on a chart, but a real hedging obligation backed by real capital. On the upside, you have a call wall at the $8 strike with over 5,500 open contracts. That is your immediate overhead resistance. The stock is currently compressed into a tight range between $7.50 and $8, with institutional mechanics creating pressure from both sides. And the final piece, the put-to-call volume ratio, is 0.59, meaning traders are buying significantly more calls than puts right now. The speculative positioning is tilting toward a breakout, not a breakdown. In the short term, your primary focus is that $7.50 put wall. It must hold. A clean daily close below 750 triggers negative gamma hedging from market makers, forcing them to sell mechanically and accelerating the downside. That is the risk. Also, watch the short borrow fee rate, currently at 1.87%. A sudden spike in that rate means shares are becoming extremely hard to locate, one of the earliest signals that short sellers are running out of room to maintain their pressure. For longer-term investors, you need the market to absorb those 3 million-plus newly registered shares. You need Cyberhawk and Omnis integrations to convert the order pipeline into recognized revenue, and you need SEC Form 144 filings to confirm the insider selling has finally stopped. When those boxes start getting checked, the technical headwinds exhaust themselves, and the path toward $18.50 begins to open. The trade setup for June 26th is a speculative long positioned for a mean reversion bounce driven by short squeeze mechanics. Entry zone is $7.60 to $7.70, close proximity to the institutional put support at $7.50, while the stock remains in extreme oversold territory. First target is the $8 call wall, aligning with the 20-day moving average. If the stock breaches $8 convincingly and short covering ignites, the second target becomes the 50-day moving average at $8.71. Hard stop is a daily close below $7.30. Below that level, the setup is invalidated. Protect your capital without hesitation. The mathematics here are straightforward. Small, defined downside risk against a volatility-driven upside opportunity, backstopped by the most extreme short interest reading I have encountered all year. For long-term investors, this is ultimately a patience game. The market needs time to digest the dilution overhang. The order pipeline needs to convert to recognized revenue, and once those two dynamics resolve, the path toward the median Wall Street price target becomes a realistic destination rather than a distant wishful projection. Here is the bottom line. The fundamental business is genuinely strong. Record defense orders, Tier 1 Lockheed Martin partnerships, an expanding acquisition strategy, and nearly $400 million in projected revenue for the year. The stock has been systematically destroyed by insider selling, dilution fear, and a momentum collapse. The RSI is at exhaustion. The 290% short float is one of the most extreme anomalies in the entire market right now. The options chain is providing a concrete institutional floor at $7.50, and Wall Street carries a median price target over 140% above where we are currently trading. The disconnect between operational reality and market price is real. The spring is fully loaded. Before I let you go, I want to be completely clear with you, because this part matters. Nothing in this video constitutes financial advice. I am not a licensed financial advisor. This content is produced strictly for informational and educational purposes only. Ondas Holdings carries real and serious downside risk. Continued dilution, further insider selling, failed acquisition integration, and the possibility of a full structural breakdown below key support levels. Never invest capital you cannot afford to lose. Always conduct your own research, consult a licensed professional where appropriate, and size your positions according to your personal risk tolerance and financial situation. This analysis reflects conditions as of the date of publication, and markets can change extremely fast. Now here's the question I genuinely want your take on. Do you believe a short interest of 290% of the float is a coiled spring about to trigger an explosive upward move? Or do you think the insiders cashing out are telling us something that Wall Street analysts have completely missed? Drop your honest take in the comments right now. I read every single one, and the conversations in this community consistently make all of us sharper, more disciplined investors. If this analysis gave you even one useful edge today, please take 2 seconds and hit the like button. It genuinely helps Smart Stock Sam reach more people who are looking for this level of rigorous quantitative research. And if you are not subscribed yet, now is the time, because we produce this quality of breakdown consistently and you do not want to be late to the next one. If you want to go a step further and directly support this channel, you can send a super thanks right here on YouTube. Every single contribution helps us keep delivering this level of work, and it means more than you know. Finally, if you are serious about leveling up your investing and trading, the Smart Stock Sam membership is now live on YouTube. Members get early access to analysis, deeper trade setups, and direct access to our exclusive community of focused, serious market participants. The link is waiting for you in the description. Come level up with us. This is where the real edge lies. I will see you in the next one.